Michael Sonnenfeldt is back with us now. Michael, it's good to have you on. This is a stock market that, not the last couple of days, but really keeps going up. Are we seeing any more love from your members about stocks, or is it still really about real estate?
Actually, they just pulled back a couple points in the last quarter from the stock market and from real estate, still strong in private equity. But for the first time, cash is coming up a little, fixed income is coming up a little, and gold and Bitcoin. So a little bit of a shift, maybe a little bit of caution.
I was going to say that sounds a little cautious. Now, your members, and I've gotten to meet so many of them, they're from all over the country and all over the world, and they're fantastic. A lot of them founded and sold companies. A lot of them might own 100 Verizon stores. And so they've got their pulse on the consumer. Do you feel like this is indicating a little economic nervousness?
You know, we're still overwhelmingly weighted for the mid and long term in equities. So there's long term bullish, but in the short term, it's a little choppy water. So people are trying to steady the boat in a rocky road.
You said Bitcoin. Has it taken some time to I see it every quarter. There's a little more Bitcoin, a little more Bitcoin. I feel like it's finally crossing that hurdle of we got to own it.
Yeah. So Bitcoin as a market is still only a tenth the size of gold, but they both are secure assets in members' mind. For the first time, people aren't talking about Bitcoin just as speculation, but actually an alternative asset that can be held during tough times. Not everybody believes in it, but those that do are making a big splash.
Well, it went from, so Bitcoin was sort of, I've been coming to your meetings for over a decade, and Bitcoin was sort of spoken about in the hushed corners of the hallways 5 or 6 years ago. Now you've got panels on it. People are talking about it. It's gaining more acceptance. Do you have any visibility on what maybe the next thing? Private equity has been growing. Where are people turning to?
You know, I think in this rotation, people are going a little more caution. When you've created as much wealth as our members have, average member over $100 million, they're looking to preserve wealth first and foremost and grow it secondly. So the growth part is less important than preserving what they have. That's a good rule. If you can keep what you have, you'll do pretty well.
Is it then the return of capital more so than the return on capital?
It's making sure that you're not taking crazy risks that set you backwards. It's much harder to make up lost ground than to stay steady and move forward.
Well, this is an important thing, okay? And this is what I love about so many of your members, like Sean, his fish guys and whatever. You grew up scrappy. Joe Mowgli grew up, his dad, was an Italian immigrant, grew up with nothing. Just busted their butts. I almost said something else, busted their butts. And so many of your members are first generation. They made it. They did it. And now they've got the money. They want to enjoy it. And you help also, I think Tiger helps them guide to the next generation, because you also want to your point, not lose what you spent 50 years building, right? I mean, that's a critical aspect of being a founder.
Yeah. You know, one of the things that's interesting, you take Warren Buffett, the world's supposedly greatest investor. His track record has been 20%, but he's been doing it for 65 years. Our members, to become Tiger members, had higher returns than 20%, and they could never duplicate those returns as investors. So this divide between being an entrepreneur for 5 or 10 or 20 years and creating extraordinary wealth, and then what do you do with it? It's the reason why Warren Buffett has told his heirs to put it in the S&P, because even they won't be able to get the benefit of his track record.
So when you say
forward.
Returns, do you mean that they're not investing in equities to the point you're saying is they're putting their money that they've made, let's say they own 1 restaurant, then they own 2, then they own 4, then they own 16. They're reinvesting that capital and the sweat equity back in that business.
But generally, when they've had a liquidity event and sold the business, now they're becoming investors. They've gone from entrepreneur to investor.
It's a different skill, though.
Completely different skill. And more importantly, their kids, if they want to preserve the wealth, are not going to do it as entrepreneurs, except in rare instance, they're going to have to do